Hello and welcome. I'm Jonathan Tepperman, Managing Editor of Foreign Affairs Magazine, and this is Foreign Affairs Focus. It's my great pleasure to have with me today Ray Dalio, the founder of Bridgewater Associates, the world's most successful hedge fund. Ray has been rated by Time Magazine one of the 100 most influential thinkers in the world, and he's here with us to talk about the global economy. We're going to jump around a lot, Ray, so let's just get right into it. Big court decision in Europe today, the German Constitutional Court approving the ECB's new bailout mechanism. What's your general take? You've been quite pessimistic about European, especially Spanish risk recently. Does this change the picture or not?
I think that there's a natural dynamic of different vested interests between Germany and then within Germany, the Bundesbank, the Constitutional Court, and Merkel's coalition. I think that we're now that we've passed an inflection point in which the central bank now has the capacity to print money. Ultimately, in all of these deleveragings, we come to the point of, will the central bank print money? And there was a tension between the Bundesbank and the Germans about that issue. And there's a realization that the ECB has the votes, because it's controlled largely by Southern Europeans, to be able to print the money, and they will go ahead, and that Germany, in terms of the particular control of the ESM, that was really what the court decision was focused on, will be able to participate in the anticipated manner in the ESM, and that the fiscal contributions as proposed can exist. It cannot increase more than is proposed. That fiscal piece is a limited amount and will not be what Europe turns on. It'll be the monetary piece. And now we're going to go to a more balanced dealing with the crisis, because there will be a mix between monetary policy and fiscal policy in filling up what this big gap is. That gap is a 2 trillion euro gap, and that has to be filled mostly through monetary policy.
But do you see this as potentially starting Europe down the road to recovery? I mean, one of the striking things about the now several-year-old crisis is that we're at a point of no return, it seems, every couple of months. And what crisis will be resolved, and then a few months later, we're right back in it. Do you see the trend now moving in a positive direction?
No. No. I think there will always be, look at it this way. There's going to be about 2 trillion euros worth of losses over the life of the loans. The banking system has about $31 trillion in assets. There are sovereigns is about $3.5 trillion. There is not an ability to meet that funding. That gap has therefore got to be met either through a writing down of that debt and a contraction of spending, so that there's a contraction, or it has to be plugged through fiscal or monetary policy. There is a very limited amount of fiscal contribution. There's about 500 billion euros. You add in the IMF and so on, you might get that number up to 800 billion euros to plug a problem that's multiple that size. That means that there has to be monetary policy. So we are going to have a contraction. We're going to have a contraction in balance sheets. We're going to have a contraction in debt, and we're going to have much worse economic conditions in Europe for a long time. It's a classic deleveraging. We call that the lost decade. It's going to be a long period of difficult time, particularly in Southern Europe.
Let's jump around the world a little bit if we can. At the same time that you're quite pessimistic about Europe, I've read that you're much more optimistic about emerging markets. Now, other analysts are starting to change their take as we see a slowdown in China, Brazil, India, Russia, et cetera. Tell me where you are on EMs today and why.
Emerging ultimately, the economics of a country is very similar to the economics of the individuals who make up that country. So the question is, who has the surpluses, and are they adding to those surpluses? Of course, politics enters into it, but the problems that they can't control are when external countries don't lend them money. Emerging countries are running the surpluses, and they're the creditors. So I'll take one by one as we go through them. Their circumstances are very different, but generally speaking, emerging countries are in better financial condition than the developed countries.
Let's turn now to the United States, if we can. A particular question to start with, what do you think of Bill Gross's recent comment that equity market, stock markets are a Ponzi scheme?
It depends what he means by that, you know? Like every market is a greater fool theory.
Right.
It's really a function of the people who are dealing with it, right? Equity markets probably over the next number of years will be better performing than bond markets.
But what about this idea that the age of big returns is over?
The age of big returns is over. Of asset classes in general, and that's true of bonds. That's true of stocks for structural reasons, and that has to do with when interest rates go down, it causes stocks and bonds to go up, and when interest rates come down to zero, there is not much more room for those assets to benefit from declining interest rates. So when we look at high returns of stocks, what we had is an expansion in PEs, which are yields coming down, and that is all over for a relatively long time. There are going to be ups and downs, but what produces the high returns is structurally no longer there.
Let's talk about deleveraging, which of course is one of the big stories of our era and one that you emphasize quite frequently, how to get out from the mountains of debt that collapsed in 2008. I'm curious what your view is on which countries are doing well. The McKinsey Global Institute recently said that the United States is one of these countries that's actually making progress, but that it should be taking more measures to cut debt. What's your view?
I think that that's a reasonable summary. I think that in all deleveragings, the most important thing is to achieve a right balance between fiscal austerity and producing enough monetization of debt to achieve an interest rate that is below the nominal growth rate. So that over a period of time in an orderly way, the debts go down relative to the incomes. So lowering debt to GDP ratio will happen in an environment in which there's about 2% growth and a certain amount of monetization and a certain amount of fiscal austerity. And that getting that balance right is really the most important thing over a long time. It's like if I'm asking you to exercise, okay, it's just going to be day in and day out that you do the right balance over the right period of time. If you do too much or too little, you're going to be in trouble. And so that is the best way to describe what the United States is able to do, because it also has an ability to print money. Printing money can be very risky. It can devalue the value of money if too much exists. But depressions happen when none exists. When you have zero interest rate, you can't create relief. So it is in the ability and the wisdom to create that right balance of monetary and fiscal policy to do both over a period of time that is happening now and that I hope will continue to happen. There is a big fiscal challenge ahead, and it needs to be dealt with, but it needs to not be dealt with at an extreme rate.
Let me ask a more general question. What are the other big global macro stories that perhaps people are not focusing on but should? Another way of asking the question is, what keeps you up at night?
Well, so what keeps me up at night is that we are in a one world economy, and all the world's economies are now slowing, and we are close to a zero interest rate. That means that if you go down, you hit an air pocket, that there will need to be a way of reversing that, just like in any recession. The traditional way of reversing it was always to lower interest rates. That's not a possibility. So that there will need to be a mix of, if that should happen, and I don't say that it's going to happen, but if we do hear it in our pocket and go down, what worries me would be that there is not the right mix of fiscal and monetary policy to deal with it, because people are not used to, policymakers don't have the historical frame of reference. They don't go through the calculations of how much monetary policy and how much fiscal policy produces that right mix to pull it out, because they're not used to it. So and it requires it to happen globally. There's a European deleveraging, there's a Chinese leaving of a bubble and going down, and there's the United States, which is growing at a slow stall speed almost. If they were to slip together, and there is, because they're self-reinforcing, they could slip together, and there needs to be prudence at that time. And my fear would be the absence of prudence. With prudence, it could be managed. My fear is that there could be the absence of prudence.
Well, here's hoping for prudence. Ray Dalio, thanks so much for talking to us.
Thank you.